Hello, welcome to this week's Market Carver. I'm Andrew Thrasher, Portfolio Manager, and I'm joined this week by Zach Unger, Senior Investment Analyst. This week, we're going to be looking at two topics, looking at where's money going in the equity market. Then I'm going to turn over to Zach, who's going to give us a look at the real estate market, specifically retail real estate. So let's dive in on the first chart here. This chart's going back to 2020. And it's looking at the total amount of money that's going into equities. And we can see it's been quite a bit. And this is looking at net. So all the money that goes in and comes out, what's the net amount? And that's over $1 trillion has been flowing into US equity funds. So that's looking at mutual funds and ETFs and things like that. What we also want to look at, and the reason I share this chart is the lighter blue line is the rest of the world. So Europe, Japan, emerging markets, China's included in that. And we can see it's very much lagged behind as far as attracting assets. And in fact, recently, if you look on the far right side, it's actually started to dip lower. We, as our thesis and the way we look at international markets is we want to see them perform both in an absolute term, so seeing prices rise, but we also would like to see them improve against the domestic markets. So if we're going to take on that risk, we really want to see those foreign markets starting to do better than the markets here at home, and that hasn't been happening. In fact, they've been underperforming for quite a while, and this has contributed to why we're not really seeing a lot of assets flow into foreign markets. This tells us two things. One, it tells us there's possibly opportunity there, that not a lot of investors are getting exposure to foreign markets. So if we do start seeing those turn higher, we start to see improvement there, that there's a lot of gap there in the flows data showing that there's still a lot of money that could potentially go to international markets. But we really need to start seeing some of their price data improve for that to happen. The second thing, again, is looking at the sentiment and the fact that everyone is very heavily focused domestically. And so if we start seeing domestic markets start to falter, that there's quite a bit of assets that have flowed into those domestic U.S. equity funds, and we can start seeing those pull out. Now, so far, the markets have done very well these last several years, and that's contributed to why, again, we're seeing a lot of flows into domestic funds, but it's creating a very large spread between domestic and foreign, and it's more a matter of when versus if, when we start seeing that close, as we start seeing market cycle. And that's something that's definitely on our radar for next year, but we need to really start seeing some confirmation of that change before it's an opportunity that we view as one worth taking advantage of. Now, next I'm going to turn over to Zach, who, like I said, is going to start talking to us about the real estate market.
Yeah, so many of you have likely heard us talk on here or talk to your advisor about the potential benefits of allocating a portion of your portfolio to alternative assets, or what we would call core plus. As a side note, if you haven't had that core plus with your advisor, certainly worth making a note to bring that up in your next family update. Under the broader umbrella of alternative assets, there are really four main categories, real estate being one of those four. And then you can break the real estate bucket down into its various sectors. So think multifamily, industrial, retail would be one of those, which we'll drill into here a little bit more. Three charts rather. We'll kind of go one by one and break them down to paint the macro picture, talk about some of the tailwinds that are driving value in the space. So the top chart there, the gold or yellow bars are new constructions of retail space. And then the gray bars on the bottom are demolitions of retail space. So the two things that I would point you to here, really since 2015, 2016, you've seen the new constructions pretty steadily decline. And then in the late teens and through last year, maybe the year before, demolitions have started to pick up. So while the net is that we're still bringing more retail spaces online, the pace at which we've done that has slowed quite a bit. And that's important because it impacts the supply and demand dynamic, which leads us to the chart on the bottom left, which shows retail vacancy rate. So retail vacancy rate is a great indicator of the supply-demand dynamic. What you'll see is when demand is high, those vacancy rates drop pretty low. And the inverse is also true. When demand is really low, vacancy rates are high. Companies aren't rushing out to occupy the spaces that are online, and so many of them sit empty. As we stand right now, vacancy rates are near or at all-time lows at 4%, which tells us that there is strong demand for the retail space that's online. The other part of this is the bottom right chart, e-commerce as a percentage of total retail sales. You can see since 2000, that's really steadily increased. And in 2020, when we saw the pandemic lockdowns, you can see the chart almost goes vertical there as e-commerce took on a significant portion, up to 16% of the total retail sales. Within the retail real estate investment space, there was somewhat of a fear that e-commerce would continue to dominate market share and take more and more and more and render the brick and mortar stores kind of useless or less valuable. But after the COVID lockdown, the pandemic stuff sort of subsided, what we saw is that consumers really flooded back into the brick and mortar space. And so that tells us a couple things. One, there are still experiences in-person shopping that can't be had online that are really valuable to the consumer. An example that I read about was TJ Maxx. You have nice quality brands that are coming into stores at discounts, and you can kind of go treasure hunting a little bit in the store, which isn't an experience that you can get online. And so there is value to be had there. The other thing that we've seen is companies have repurposed or altered how they're using some of their brick and mortar stores. So it's not exclusively just for in-person shopping, but what they've done is they've gone from just that model of in-person shopping and then shipping e-commerce from a warehouse to now shipping direct to your doorstep from individual stores. And so the individual stores are functioning as sort of satellite warehouses, whereas they used to just ship everything from large warehouses. So a little bit of a repurposing there. And this is really, really good because it shows some strength in the retail real estate investment space. When we think about real estate as a whole, we are fairly bullish on the space moving forward, especially in a declining interest rate environment. And it's important to see strength in each of the sectors or in many of the sectors rather than concentrated in one area. So seeing it in retail, strength there is beneficial for the real estate market as a whole.
All right, thank you, Zach. If you'd like to schedule a complimentary Next Steps meeting, please look at our phone number on the screen, our website, or scan the QR code, and one of our advisors would be happy to set up a time to meet with you. We look forward, hope you enjoy the rest of your week. We look forward to bringing you another Market Carver next week. Until then, goodbye.